Welcome to our viewers. I'm Tim Coughlin, along with Gay Truscott, and we are pleased to bring you our video presentation of Edgemoor Investment Advisors' fourth quarter 2023 report. Our agenda is to review the financial markets in 2023, to explore the Federal Reserve Bank's federal funds rate future movements, to discuss the U.S. economy, to provide our outlook for 2024, to discuss portfolio implications and actions, and to present our analysis of a couple of stocks. We begin with Gay for her presentation of current market and economic conditions and our outlook going forward. Gay?
Thank you, Tim. Investors found much to celebrate as 2023 came to a roaring close. The market's positive momentum accelerated in the fourth quarter, sending all major stock indices at or near record highs in December. Bolstered by a combination of a solid economy, better than expected corporate earnings, and the anticipated end to the Federal Reserve's long rate tightening cycle, stocks rallied strongly in the fourth quarter to finish out the year on a high note. It was a significant reversal of the pessimism many investors felt at the start of the year after a disappointing 2022. The S&P 500 index posted a total return of 11.7% in the fourth quarter, its best quarterly performance since late 2020. And an impressive 26.3% total return for the year. Even more impressively, the S&P 500 came within striking distance of its all-time high when the index hit 4793 on December 28th, only to retreat slightly on December 29th, the last trading day of the year. The bond market also rallied strongly in Q4. Erasing a modestly negative return for the first 9 months of the year to post a positive 5.5% total return for 2023, avoiding what could have been a third straight year of losses for bonds. I also want to mention that the fourth quarter saw a welcome broadening of the market rally, with nearly 90% of the stocks in the S&P 500 trading above their 50-day moving averages. This marked an important change in what had been a market characterized by very narrow leadership for most of 2023, with only a handful of mega-cap technology stocks gaining ground, while the rest of the market languished. Driving the late-year rally of both stocks and bonds was investor optimism that, in addition to ending rate hikes, the Federal Reserve may pivot and start cutting interest rates sooner than expected. After maintaining a stance for months that investors should not expect rate cuts anytime soon, the Fed released new economic projections in mid-December that suggested the possibility of 3 rate cuts in 2024. This slide shows the steady rise in the Fed funds rate from mid-2022 through late 2023, when the Fed took a pause. Now the expectation is for up to 3 rate cuts in the latter half of 2024 to end the year at a target range of 4.5% to 4.75%. The primary rationale for the Fed's pivot on rates has been the steady decline of inflation from its peak in June of 2022. This slide shows the Consumer Price Index, the broadest measure of inflation, has cooled considerably from its peak of 9.1% in June of 2022. While it moved around a bit in the latter half of 2023, the overall trajectory of inflation has been down. And if this downward trend continues, it will certainly support the narrative that the Fed could, quote unquote, give back some of its interest rate hikes in 2024. Amidst this backdrop, the U.S. economy has remained remarkably resilient, particularly in the face of predictions by many at the start of the year that 2023 would see that inevitable recession. Instead, the U.S. economy has been characterized by continued low unemployment, strong GDP growth, and solid corporate earnings. The unemployment rate in the U.S. stayed steady at 3.7% in December, capping off 2 years of remarkably low and steady unemployment. With workers still in high demand, median hourly wages have also risen over the past 12 months, another strong sign for the labor market. On the economic growth front, U.S. GDP grew at an annualized rate of 4.9% in the third quarter of 2023, its fastest rate in nearly 2 years. Much of the growth was driven by U.S. consumers, who collectively increased spending by 3.1% in the third quarter. Fourth quarter GDP is also expected to rise by 2.4%, thanks to robust holiday sales. Corporate earnings have also remained solid, with third quarter S&P 500 earnings growing 4.9% year over year, significantly ahead of expectations and reversing 3 consecutive quarters of earnings declines. Earnings for the fourth quarter of 2023 are now expected to be flat compared to the fourth quarter of 2022, before growing again this year. All of these factors point to an economy that is making the quote-unquote soft landing that the Fed was aiming for, but that many were skeptical could be achieved. Looking ahead, we would characterize our outlook for the economy and markets in 2024 as cautiously optimistic. Growth is slowing, but still positive, and corporate earnings remain solid, both of which are good for the stock market. In addition, the continued adoption of artificial intelligence across numerous industries and applications most certainly will drive long-term growth and productivity in the U.S. economy. And as I mentioned, recession fears have eased, and a soft landing now seems possible in 2024. Stocks are considered fairly valued, with the S&P 500 index trading at about 19.5 times forward earnings, roughly in line with its 5-year average. In addition, the equity rally has broadened beyond the Magnificent Seven that dominated last year. Those are Apple, Amazon, Facebook, Google, Microsoft, Nvidia, and Tesla. A broader market rally is generally considered stronger and more sustainable. But of course, there are risks. The geopolitical landscape is uncertain, with an expanding crisis in the Middle East, the ongoing war in Ukraine, and serious economic issues in China. Closer to home, the continuing gridlock on Capitol Hill and the 2024 election cycle will most certainly pose near-term distractions. But overall, we maintain a positive, long-term outlook for the U.S. economy and markets. Now I will turn it back over to Tim for a discussion of 2 securities we are currently buying for client accounts.
Thank you, Gay. As we consider current economic and market conditions, we continue to find pockets of investment opportunity. We continue to invest in cash short-term treasuries and money market funds at 5% yields, and we continue to maintain our long-term value-oriented investment philosophy. Here is our analysis of 2 stocks we are currently buying. The first is Alphabet, and the second is Vertex Pharmaceuticals. Alphabet Inc. is a global technology company best known for its dominant internet search engine, Google, which controls more than 91% of the global search market. Additionally, The company owns the Android mobile operating system, which powered roughly 70% of smartphones worldwide as of December 2023. Alphabet shares had a terrific 2023, with a total return of 58%. Most of the company's revenue is derived from digital advertising, which accounts for approximately 75% of Alphabet's total revenue. Google Cloud is a more nascent business for Alphabet, but the company is a rapidly growing cloud market enterprise. Moreover, the introduction of artificial intelligence has provided yet another secular tailwind to fuel Alphabet's continued growth. We view the company favorably due to its continued growth and its fortress balance sheet. Alphabet has compounded its revenue growth at an annualized rate of 19% since 2011, and it is projected to deliver annual earnings growth of 17% over the next 5 years. Additionally, the company held $120 billion of cash and marketable securities compared to only $14 billion of long-term debt as of September 30, 2023. We believe Alphabet shares warrant a premium valuation due to its higher than average growth prospects, strong returns, and competitive advantages. Vertex Pharmaceuticals is a biotechnology company with the dominant market position in the treatment of cystic fibrosis, a rare genetic disease for which the company's therapies are the standard of care. Sales of Vertex's 4 therapies for cystic fibrosis are headlined by Trikafta, whose patents in the United States and Europe run through 2037. The company's ongoing treatments have increased the average patient's life expectancy from the mid-30s to the mid to late 70s, allowing Vertex to steadily increase its revenues and profits. Its stock had a total return of 41% in 2023. Going forward, the company has several promising new medicines in the pipeline that represent multi-billion-dollar revenue opportunities. Vertex recently announced positive news regarding a treatment for acute pain, which has the potential to provide effective pain relief without the side effects or addictive properties of opioids. Vertex is financially strong. The company has no long-term debt and nearly $13 billion of net cash on its balance sheet. We think there are multiple avenues for continued success with Vertex, and the stock represents a compelling long-term value for investors. Gay and I have now completed our report on current economic and investment market conditions and 2 stocks we are currently purchasing. Thanks for tuning in to our report. If you have any questions or comments about our report, just give us a call.